Hello, Kumar.
Hi, Yojo. How are you?
I'm fine, thanks. And you?
Yes, I'm fine. Thank you. Sorry, we had a very bad day yesterday. Today it's slightly better, much better. So I can manage the class today.
Okay, but is it something usual that you have problem with the weather over there?
Suddenly, when the monsoon showers have come suddenly, so when it comes, certain times the power, when there are a lot of thunder and lightning, they switch off the power to for protection.
Yeah,
Yeah,
I know.
yeah, because sometimes it so happens that there are a lot of thunder and lightning. In that case, we are not supposed to use our computers and all that. So what they do is the authority, they switch off power so to make the people safe.
Okay.
Okay, right.
I see.
Yeah, but today we are all right. Today not too much of rain. There is rain, but not too much of lightning and thunder at the moment.
Okay.
Okay.
Much better.
Yeah, definitely. Yes. Right. So remember we were in the long-term borrowings, a loan subject. So we were discussing two types of long-term funding. One is equity capital. Equity capital, we can get it in three forms. One is initial public offering for a listed company. Then a placement for a non-listed company before going for listing, where you select some good, rich people to invest in your company so that your company profile go up before going public. Then the third one, after going public, normally what we do is we come out with what we call a rights issue, and whenever a rights issue comes, that means the people, the existing shareholders are offered shares to buy in a company at a discounted rate. Why we need money is for investment, to look at new growth, we need money. So whatever the way you take equity money, the return is paid in form of dividends by the company, and also the shareholder will have the opportunity of getting a dividend and also a kind of a capital gains, the shares appreciating in price and gaining and having a capital gain. So most of the people invest more than for dividends, but for capital gains. If the companies do well, the share prices will go up, and that will make your project, your company a better kind of a project. Then the other way is to take loans. When we take loans, the company is under obligation to pay interest. Whether you have profit or not, whether you have money or not, you must pay interest. If you don't pay interest, the lenders can take the company to court. Interest is a tax deductible expenditure. Dividends is not tax deductible. It is paid out of profit. So therefore, it is not tax deductible. So we're discussing the types of borrowings the companies can go. One is money market borrowings. Essentially, this is for banks, interbanks. For banks to borrow is money market borrowing. Essentially, they are very short-term borrowings. Surely less than 1 year. It can be few days, 5 days, 7 days kind of a thing, or even it can be even a 1 day. Some big companies can go to the money market, can borrow money, and also lend money for short periods. So money market is essentially short-term lending, short-term borrowing. Then we were discussing something called revolving credit facilities. It's like a bank overdraft what we have, or like a credit card limit what we have. Up to the limit we can use it, and we pay interest only on the amount we have used. So if we get a bank overdraft, shall we say $100,000, if we are used only $20,000 today, we have to pay interest only on the $20,000. Tomorrow, if it goes up to 30,000, we have to pay on the 30,000. Next day, if we deposit 5,000 and comes down to 25,000, we have to pay only on the 25,000. So you don't need to pay on the entire 100,000 overdraft facility. You pay only on the amount utilized. Similarly, the companies can get what we call big overdraft, I would say, what we call a revolving credit facility. A limit is set for you. Up to that amount you can draw, or you can deposit money. Within that limit you can use the facility. We pay interest only on the amount we have withdrawn for a particular day or a particular month. That's all we have to pay interest. We don't need to pay on the full facility. But if you take a loan, say if you take a loan of $10 million, whether we are used it or not, from the day one, we have to pay interest on the entire 10 million. But if you take a revolving credit facility of 10 million, today if you use 1 million, you pay on 1 million. Tomorrow if you use 3 million, you pay on the 3 million. Next day, if you deposit some money and it comes down to 2.5 million, you pay on 2.5 million. So it's like a big mega overdraft, I would say. Generally, single bank will give to a single company, but sometimes the banks also want to share the risk. So they don't want to take the entire risk, so they might join with many banks and give your company a facility which we call a bank syndicate or a bank consortium. So rather than one bank taking the big risk of giving a big facility, they will get together and give it, and they will share the interest or the profit according to the portion what they have given. They will get the interest and they will share it. So this is essentially long-term loans where you have a facility which is somewhat fluctuating, and it can be a very flexible kind of a financing arrangement. Next one is what we call the capital market. You remember capital market is a stock exchange where we go to issue shares or even for a rights issue. But even similarly, like shares, we can go and issue what we call bonds. Bonds are not shares, but they are issued through the stock exchange. They are essentially loan notes or loan instruments. So basically, the company will say, generally in most of the countries, the bonds, the nominal value is $100, 100 pounds or 100 euros, whatever the currency. Unless the examiner says something different, normally we can assume always the nominal value for bonds is $100, 100 sterling or whatever it may be. So if you want to issue 1 million bonds to the market, but the money you will get is 1 million into 100, the nominal. But you might issue the bond, even though the nominal value is 100, you can issue it at 110, you can issue it at 95. Just like the shares. Shares, it has a nominal value, but you will issue it always at a higher price than the nominal value. Nominal value of shares is normally $1, but it could be 50 cents, it could be $10 or whatever. So, on the loans, on the bonds, the interest is paid. Unlike in the dividends where you pay dividend per share, here you pay on the nominal value a percentage. So you remember we discussed this one in the preference shares. Preference shares we pay on the nominal value a percentage. Similarly, for the bonds, the interest is always nominal value, a percentage on the nominal value. You pay a percentage on the nominal value. So as I said, the nominal value can be $100. Nominal value is always $100. So when the company says it's paying 6%, 6% loan notes interest or 7% loan notes interest, it is paid on $100 always. $6, 6% means $6 will be paid on the nominal value. So if you are holding 10 loan notes, you will get $60 interest every year, and that is mandatory. The company must pay. This 6% is called coupon rate. Coupon rate. So whenever the examiner talks about coupon rate, that means the percentage on the nominal value. So the bond is like a loan. The issuer is the company. They issue it, and you and I, we invest. So issuer is the borrower, and we, the investor, is the holder. And so whenever the examiner says the company is issuing, you have to remember issuer is the lender. Sorry, issuer is the borrower. We who invest is the lender or the investor. So generally bonds provide some kind of an external source of funding, and they are generally long-term funding. Money market is short-term funding. Bonds are long-term funding. The bonds will not give you any ownership rights. Shares will give you ownership rights. So the bond holders will not have right to vote at the general meeting, to elect directors or to appoint auditors or something like that. So they can hold 10 million loans, a particular investor, but he will not have any voting rights. He is not an owner. He is a creditor to the company. And in the balance sheet, he will be shown as a non-current liability. But even if you invest $100,000 in equity, you are an owner. And that will be shown as under share capital, under equity, and that is ownership right. So however much bigger the loan amount, you are not an owner of the company. You don't have any voting right. But even a little shares, you become an owner of the company and you have the voting right. Once they have a definite redemption period, they will say 2020, 2025. So normally when they say 6% bonds, 2020, that means annually you have to pay 6% interest on the nominal value, and it will be redeemed in 2020. So that's what the terminology when you say 6% 2020 bonds. But we know the shares, no redemption, shares will remain all the time in the company till the company goes for liquidation, or in certain exceptional situations where the company is given the right to purchase its own share. This is another kind of a new kind of a borrowing which came in the recent past, what we call commercial papers. Commercial papers is a kind of a borrowing where large companies, not you and I, not the small people, but the big companies can go to the market and issue what we call a commercial paper, and generally it's for about a 9 months period, less than 1 year. So it is issued for them to raise money, and commercial paper is also something which is tradable. You go to the stock exchange and raise money, and if I take a commercial paper of your company worth, say, shall we say 1 million, I can hold it till the maturity and get interest and 1 million, or I can sell it to another party, maybe for 1,010,000 or something like that. So they are tradable, just like the bonds, just like the shares, they are tradable, and that's what we call commercial paper. They are essentially short term again for a maybe maximum 9 months period. Who are the players in the capital market? Capital market means the stock exchange. So there are three main players. One we call the issuers. The company, they are the people who come to the share market, come to the bonds market and issue shares or issue bonds. So they are called the issuers. Government also come to the market and issue treasury bills, and they are also a kind of issuers. Then the purchasers, the people like you and I, the individuals will purchase. Sometimes the governments, foreign governments will purchase. Now, for example, when the United States of America comes to the market and raise money, most of the time they are bought by China or by Japan. Then in between, we have what we call underwriters. Here, they are the people who facilitate to sell bonds, and generally, they are investment banks who will facilitate the purchase and sale of the bonds, that kind of a thing. So, they are called the underwriters. So, something about the bonds. When it comes up for bonds, there are two main types of bonds that come up. One called redeemable debts, other one called irredeemable debts. Redeemable debts, irredeemable debts. Even though the name says so, all the debts are redeemable. But what is meant by irredeemable and what is meant by redeemable is sometimes the company can come to the market and issue bonds which is worth $100. They will issue it at 95. Nominal value is 100, but they will come to the market and issue it at 95, and they will say they will redeem it at 100 or they will redeem it at 105. So this is issue price, the redemption price. So where there is a difference between the issue price and the redemption price, that kind of a debt is called redeemable. Where the issue price and the redemption price are different, it is called a redeemable debt. Where the issue price and the redemption price is same, like a bank, for example, a bank loan, if you borrow 100,000, you have to pay interest, but you will settle as a capital only 100,000. You are not going to settle 105,000. You are not going to settle 99,000. There the issue price and the redemption price are same. In that case, we call it irredeemable debt. So, irredeemable debt. So, generally, irredeemable debt has a very high degree of security, mostly given by the banks. And whenever the bank will ask for the various security. You remember we discussed floating charges, fixed charges, and all that. So, on the irredeemable debts, the yield or the return to the lender is I. I is the interest rate. So, let's assume it is 8%. Banks gives you a loan, it's going to be 8% times 1 minus T. T is the tax rate. So if the bank has to pay a 20% tax, 1 minus 0.2 divided by the PO. PO is the current market price. In the bank loans, it's the same as the redemption price. So you don't need to put it, it is 1 minus 2. But if the redemption price is different, you will put 1 minus 2 divided by the current purchase price. Current price of the debt and T is the tax rate. When it is redeemable debt capital, where I told you issue price is 95, redemption price is 105, or issue price is 105, redemption price is 100, where the issue price and redemption price is different, we have something called yield to maturity. So that I will work out when I do the cost of debt, cost of capital, the next one. I will show you how to work out what we call yield to maturity. With that, we come to the end of one big chapter where we discussed about the long-term debts. Today, we are going to start on a new subject called cost of capital. Very important subject. Cost of capital. You remember I told you whether we take money from the providers, that there are two types of providers of funds, the shareholder and also the lender. Whether we take money from the shareholder or whether we take money from the lender, we have to pay them a return. For the shareholders, we pay a return in form of dividends. For the lender, we pay a return in form of interest. Dividends is not mandatory, but preference dividend becomes a kind of a preference before we pay a ordinary dividend or an equity dividend. We must pay the preference dividend in preference. But loans, interest is mandatory. We have to pay. Interest is tax deductible. Dividend is not tax deductible from the company's point of view. And also, you will agree with me, if you give me a loan, you know, you're almost sure you can get your interest. You can almost ask for a kind of a security from me, and you probably is guaranteed the interest will be paid and also the repayment of capital. But on the other hand, if you invest in my company in equity, no guarantee of a dividend, no guarantee of a repayment. In fact, no need for repayment, no need of a dividend to be paid. So if you look at your 100,000 investment in a company in form of lending as a loan, you are more secured, less risky than investing in a company in shares. So the fundamental principle in business or investment is higher the risk, higher the return. If you invest in a risky enterprise, you will expect a higher return. If you invest in a low risky enterprise, you will expect a lower return. That is why most of the people invest in government securities, government treasury bills, government bonds. They know they get a very low rate of interest, but they are quite happy to invest in that kind of a thing because the reason is they are sure of getting their interest, right? So similarly, if you look at from a company's point of view, when the company takes money, company will have to, if the company takes money in form of lending, the lender will be much more secured than an equity shareholder. So more risky. The equity shareholder is more risky. For the equity shareholder, investment is more risky. So therefore, the company will have to pay a kind of a higher dividend, even though it's not obligatory to pay a dividend. The expectation of the shareholder will be a higher return than the expectation of a lender who will get settled down for a lower rate of interest. So, as I said, both the lending and both the equity will require the company to pay a return. to pay a return. So on equity, return what we pay, the dividend, we call it cost of equity. It's a cost to the company. Company has to pay a dividend. It's a cost to the company. On loans, what we pay as interest is called cost of debt to the company. So, because loans are more risky to the loans are less risky. Investor, equity is more risky to the investor. Therefore, cost of equity is always higher than cost of debt to the company. The people who invest on equity will expect a higher return than the people who invest money in loans. Cost of equity is always higher than cost of debt. One reason is because of the high risk of cost of equity. High risk of cost of equity. Second reason, the interest what you pay is like any other expenditure like water, electricity, salaries, telephone is tax deductible. It's an expenditure. But dividend is not tax deductible because it is not an expenditure. And therefore, dividend is non-tax deductible. So when you pay, for example, $100 or say $500 expenditure as an interest, you can deduct it for tax purposes. So if the tax rate is say 20%, when you pay $500, the real cost to the company is 500 times 1 minus T, it is going to be 400. Like for electricity, it's like for water, it's like for salaries. Whatever the expenditure that we incur in a company is allowed for tax purposes, except few things like entertainment and things not allowed. Generally, most of the expenses are allowed for tax purposes, including interest, and that can be deducted for tax purposes. So even though you are paying 500, the real expenditure for the company cost of debt is only 400. If you pay interest of 500, no tax deductibility, so the cost of equity is 500. That's another reason why cost of equity is more expensive than cost of debt. One is high risk, other one is non-tax deductibility. Non-tax deductibility. So due to these two reasons, you can see that primarily the company takes money from two sources. One is equity, one is debt. The cost of equity is always higher than cost of debt. For two reasons. One, equity is more risky. Secondly, equity dividend is not tax deductible. In the company has a cost, so the funders of the company, both equity and debt holders, and both will require a minimum return on their investment, and that must be paid. So this is what we call cost of capital for the company. So cost of capital is what we have to pay for equity people, the minimum return. For the debt people, what we have to pay the minimum is what we call the cost of debt. So the return expected will vary according to the risk. Now, for example, if you invest money in a particular industry, which is not so risky, like for example, the pharmaceutical trade is a very less risky trade because, people need medicine, whether the economy is good or bad, people will require medicine. But airline or hotel industry will not do very well when the economy is bad. People don't travel, people don't go to hotel when the economy is bad. So hotel industry is more risky than the pharmaceutical industry. So if you invest in pharmaceutical industry, you will expect a lesser return compared to the hotel industry because hotel is more risky. So higher the risk, higher the return. Higher the risk, higher the cost of capital to the company. That is why all the companies will try to minimize the risk. They will put some risk management strategies which you would have learned in your P2 to bring the risk down. By bringing the risk down, you can reduce your cost of funds, cost of capital. So the cost of capital is the minimum return company should make to its investors, particularly the equity holders, and for the debt holders, whatever you have to pay is what we call the cost of funds. Cost of capital, there's a definition given by SEMA. It's basically the minimum acceptable return on investment and generally computed as a discount rate for use in investment appraisal exercises. Why do we need money? Because we want to invest on new projects. So if we are going to take money and the cost is going to be 10%, we would expect a return from the new project more than 10%. If it is less than 10%, then not worth doing that project because we have to pay to the providers of funds a 10% return. So if the project is going to bring you a 9% return, that's not a good project. That is what we do with this NPV calculation. In your P1, you would have done the NPV calculations. What we do is we take that cost of capital as the discounting rate and we do a discounted cash flow. So when it says a positive NPV, that means you are getting a return more than the cost of capital. So we say it's a good project to invest. But if we get a minus NPV discounted at the cost of capital, then we say it's a bad project because we are not earning even the cost of capital. So we say forget about the project. So cost of capital is something like an opportunity cost of finance because, you know, if you don't get that return, you will invest it elsewhere. Now for banks, there is a cost of funds. Banks, how do they get money? They get money from the customers. So they have to pay a 6% return maybe for the lenders, for the people who have deposited money. So they will invest with a company maybe at 7 or 8 or 9. So when you go to the bank will say, yes, Boja, we can give you a loan, but we will charge 8%. You might say, sorry, I don't want it at 8%, I want it at 7%. The bank manager will look at and say, very sorry, because I have another customer to whom I can give the money at 8%. So that's the opportunity cost. That's the cost of capital they want to recover because otherwise they will not give you the money. So if they don't get this return, they will give it to some other party and get the return. So when the bank offers interest, that is the yield they want it. If they don't get it, they will give it to another company. Now shareholders, as I said, shareholders are not, they don't have a right for a dividend. I mean, they can't fight for the dividend. If the company pays a dividend, it's all right. But if the company decides not to pay a dividend, the shareholders can't go to courts and demand for a dividend. But interest, they can go and demand for the interest. But just because the shareholders don't have a right to make a demand, if the company decides not to pay a dividend, what will happen? The shareholders will be unhappy. When the shareholders are unhappy, what will happen? They will go and sell the shares in the market. When they sell, when all the people start selling shares in the market, what will happen? The share price will come down because there is so much of a supply of demand, no demand, and the price of the shares will come down in the market. So the whole purpose of the company is what? whole purpose of the company is to maximize the shareholder wealth. If you want to maximize the shareholder wealth, the share prices should be higher. So the moment you don't pay a dividend, the people will be disappointed, the shareholders will be disappointed, they will start selling shares in the market, the share price will come down, and the directors have lost the objective of running the company. Why the directors want to run a company is to maximize shareholder wealth. That is not happening. So even though there is no law saying that dividend should be paid, if you keep on not paying dividend, surely you must expect things to be bad and the share prices will come down. So when you talk about the cost of capital, as I said, higher the risk, higher the cost of capital. So the cost of capital of a company is made up of three components. So in any country, without making any kind of a risk, you can invest your money in your government treasury bills and you can get a return. You can sleep peacefully, without any particular risk you can get. So that rate, what the government pays to you on the treasury bills is called the risk-free rate. So let's assume the risk-free rate is, say, some figures. Risk-free rate for the country is 4%. Now, you can, with your money, you can go and invest in a risk-free treasury bills and get a 4%. But you decide, no, 4% is not good enough and you want to invest in a company that is doing business, maybe in the pharmaceutical trade. So whatever the business, when you say business, there is always a risk, because business means there is uncertainty and there is always uh, anything can happen, whatever the business, but certain businesses the risk is more, certain businesses the risk is less. So you might decide to invest in a pharmaceutical business. It carries a risk. Because of the risk involved, you will expect a return more than the risk-free rate. So in the pharmaceutical business, you might expect a return more than the interest-free rate, more than the risk-free rate at 3%. Also, you can invest in a tourism sector, which is fairly high risk, and that also you will expect a return. You will surely expect a return more than the pharmaceutical rate. So let's assume we are going to expect a return of 5%. So this 3% or 5%, we call it the business risk. This is a risk-free rate. Business risk is different in the pharmaceutical to the tourism, and tourism is high risk and you will expect a higher return or a higher risk and therefore a higher return. Now the next one is what we call financial risk. So what is financial risk? Now a company, let's assume there are two companies. We call company P and company called company Q. In the company P, let's assume that the total funding is 100 million, and out of 100 million, 40 million has come from loans, 60 million has come from share capital. So we call gearing. What is gearing? Gearing is debt divided by debt plus equity. So debt is 40, debt plus equity is 40 plus 60. As a percentage, we call it 40%. So when you say a company gearing is 40%, what it means is out of your total funding, in this case 40 plus 60, 40% of funding have come from outsiders or from lenders. That is non-shareholders. So that is what when you say gearing 40%. Another company, they might say gearing is 35%. That means 35% of funds have come from the lenders. 65% of the funds have come from equity people. So I'm assuming in company Q, gearing is 35%. Now, I want you to look at the two companies, company P and company Q. Company P, gearing is 40%. Company Q, gearing is 35%. Now, I want you to look at these two companies and see if you are a shareholder, which company is more risky to you as a shareholder, company P or company Q? Forget about
Company Q.
Company Q is, you think, more risky.
Yes.
Yeah. You are a shareholder, right? You are a shareholder. So what is gearing? Gearing is the outside funds. That is the funds we have got from outsiders. So in company P, we have 35% outsiders funds. Company P, we have 40% outsiders funds. Company Q, we had 35% outsiders funds. Now as a shareholder, if you invest money, you think company Q is more risky, is it? Yeah? Why do you think company Q is more risky?
Yes, because if in the company Q you have less outsiders funds.
Company Q, you have less outsiders funds. Okay, good, yes.
Yeah. That means that you are gonna, your cost of capital is gonna be high in the company P.
Okay,
because
good. Good.
Because you have to pay a more premium for business risk and for.
Forget about the business risk. Business risk, we are assuming both the companies are same for the moment. I mean.
Yeah, you have to pay more interest or more. Your cost of capital is going to be higher because what we spoke before.
Yeah.
Because you have this cost is undeductible, tax deductible.
Yeah, because what you are trying to say is in the company Q, we have 35% funds, right? So we can deduct only the interest on 35% funds. In the company P, we can deduct on 40% of funds the interest.
Yes.
Right?
Okay.
Yeah.
In that case, I'm wrong.
I think
company
so.
P.
Yeah, I think so.
Is less.
I think so. I think so. P is from your point of view, from the shareholders' point of view, P is what? More risky or less risky?
Less risky.
P is less risky. Yeah. Now that is one way of looking at. One way of looking at P is less risky. But look at from another angle. Right? Forget about the cost, forget about the interest for the moment. Now in company P, there are 40% outsiders, right? So if the company makes a profit, first of all, you have to cater for 40% outsiders. I want to put up another company called R. No outsiders, zero gearing. This is 40% gearing. This is zero gearing. No lenders. Now I think it will be much more easy for you to look at. Look at the three companies, P, Q, and R. What is more safer for you? You are an investor. You are a shareholder.
I'm a shareholder.
You are a shareholder. I'm looking from the shareholder's point of view. What is more safer for you? Investing in P, investing in Q, or investing in R? R is zero gearing.
Zero gain.
Yeah.
That means that you have
No
0%
outsiders.
of
No outsiders.
outside.
Yeah. What is more safer for you as an investor?
R.
As a shareholder?
R.
R. Why? Because in R,
Because,
when you
because
invest, when the R makes a $1 profit even, from the first dollar, you can enjoy it, isn't it?
yes.
Yeah, you can enjoy it. In the now you can look at the P and Q. Look at similarly the P and Q. What is next safer for you? Q or P?
For me as an investor,
Yeah.
Q.
Q is next safe, isn't it? The most riskiest is P. Agree?
Yes.
Most riskiest is free. So I want you to note down this one very carefully. What I'm trying to say is higher the gearing, higher the risk for the shareholder. Higher the gearing, higher the risk for the shareholder. Because you have to wait. You have to wait. First, our company, you don't have to wait because you don't have any outsiders. You can enjoy your profit straight away. In Q company, you have to wait till 35% of the outsiders are paid for you to enjoy eating. In company P, you have to wait till 40% of the people are paid for you to enjoy your eating. So you can see higher the gearing, higher the risk. Now that gearing is called the financial risk. Financial risk, right? So you can see in this particular case, the company P has the higher risk. So if you are an investor in company P, you will expect, in addition to the business risk, in addition to the risk-free rate, you will expect another additional premium for, because you have a gearing, you might expect say 5%, for example. As in the company B, less risky, in the financial risk, so you might expect say, shall we say 4%. The gearing is less in the company Q. Company Q gearing is less, you will expect a lower financial risk. So you can see your cost of capital as an investor, when you make an investment decision, you will look at the risk-free rate, you will look at the business risk, you will look at the financial risk, and that three elements together is the total cost of capital you will expect from the company, or the company has to pay. So in a country where the risk-free rate is higher, the cost of capital will be high. In a business where the business risk is higher, the cost of capital will be high. In a company where the gearing is higher, the cost of capital will be high. So the cost of capital is made up of three elements. One is the one is the risk-free rate, one is the business risk, one is the financial risk. Financial risk is gearing. Higher the gearing, higher the risk. So since the business risk and financial risk is changing from one business to another, cost of capital will change radically from one to another. In same UK, the one business will have a cost of capital of 12%. In same UK, another business will have a cost of capital of 14%. Reason? It may be because of the business risk it may be because of the financial risk. So every company is interested in reducing the risk. So they must try and reduce the business risk. They must try and reduce the financial risk. So sometimes the companies will want to have low gearing, because higher the gearing, your risk is going to go up, and that means you have to pay high cost of capital. So when the cost of capital is very high, that means you have to look for, let's assume two companies. Company A, the cost of capital is 12%. Company B, the cost of capital is 14%. Now, what I want to ask is this question. Look at the two companies. Now, company A, the cost of capital is 12. So they will look for projects which they can bring a return more than 12%. So if they can get a project which they can get 12.5%, they can invest. Because the cost of capital is 12, they can go ahead. But the company B can't invest in a project which is going to bring a 12.5% return. Because the company B cost of capital is 14%, so they have to wait for projects which is going to bring them a return more than 14%. My question is, which company will have the potential to grow faster? Company A or company B?
Grow faster.
Potential to grow faster. How do we grow? By investing in new projects. Which company?
I see.
Yeah.
A.
A, isn't it? Because A can grow very fast, because they can invest in projects which are going to bring a 12.5% return, 13% return, 13.5% return, 14% return, they can. But company B can't invest. Company B has to wait. No, can't. Till they get a project which they can bring. So by that time, company has done 3 more projects before the company B can even think of doing one project. So because of that, it is good for companies to reduce the cost of capital. By reducing the cost of capital, the potential to grow is more and more. So that is why the board of directors will look at all the time to reduce the cost of capital. How to reduce the cost of capital? You must see whether we can reduce the business risk. Even if it is the same business, it all depends how you manage the risk, and the risk can be changed. And then other one is to reduce the gearing. Try and reduce as much as possible outside borrowing. But you told me a very important thing. When you borrow outside borrowing, you might have another problem, because outside borrowing is much more cheaper than cost of equity. Cost of equity is very expensive. So we have to look at from another angle. So we will look at that in a moment.
Okay.
It is very interesting, because we will get a lot of things out of this whole thing. The cost of debt, as we said, it has a very high degree of security. Interest is an allowed expenditure for tax purposes, and therefore cost of debt is less than cost of equity. 2 reasons: because of the less riskiness, and also because of the tax deductibility. So as I said, there are 2 kinds of debts we discussed: irredeemable debts, redeemable debts, but technically all the debts are redeemable. Irredeemable debt means it's only a technical name. That means the issue price and the redemption price are same. For example, the bank loans. When you take 100,000, you settle 100,000. So for that kind of a thing, the cost of debt is 1 minus T. So as a percentage, because your market price is not going to change. So for the bank loans, if the bank loans, for example, you are paying 10% interest, cost of debt to the company is 10% times 1 minus T. 1 minus T is tax rate is say 30%. Minus 0.3, so it is going to be 7%. So that is what the cost of debt for irredeemable debt, right? If it has a market price, then you will
Could you
deduct.
say that again? Kumar, sorry, could you say that again? Because I couldn't hear you.
Okay, sorry. Right. What I said was, say if the bank is charging you a 10% interest on your bank loan, and if the tax rate is, shall we say, 30% for the company, so we can deduct the cost of debt is the 10% times interest rate times 1 minus T. T is the tax rate. So in this case, it is 0.3, 30% means 0.3, 1 minus 0.3. So it is 1 minus 0.3 is 0.7 into 10% is 7%. Is it clear?
Yes, it is.
7%. If for example, so for because bank loans there is no market rate, market thing, so the rate will be always 7%. That's all. So later on we will talk about where the marketable debt comes. You have to look at the market price. So now let's assume similar situation. Let's assume we have issued some bonds issued at 100, redeemable at 100. So that is also what we call irredeemable debt, but maybe on the day of the transaction, the market price is 95. So similar thing I'm working. Let's assume the coupon rate is 10% in this case. Market price is 95. Now you can work out and see as a percentage, it is 10 times 1 minus 3, which is 0.7, right? 10% into 1 minus 3, it is 7%. 7 divided by 95 will give us as a percentage 7.36. So as a percentage, 7.36 as cost of debt. That is where you have a market price for the debt. Bank loans, no market price. So it is simply cost of debt is equivalent to interest times 1 minus T. But wherever there is a market price, then divide it by the market price, multiply by 100, you will get the cost of debt. So I is the interest rate, P naught is the current price of the debt, and T is the tax rate. So the other one is something which I'm going to talk just now in a minute. Is what I told you earlier also, yield to maturity. That one now. Now, the next one what I'm going to talk about is about this one that is called redeemable debt capital. Remember what I told you, redeemable debt capital? It is the where the issue price and the redemption price are different. So let's assume today you are putting $95 in an investment. The nominal value of this is $100. Rate is $6, 6%. And at the end of 3 years, the company is promising to pay you $105. Issue price is 95, redemption price is 105. Now imagine you invest. Year 0, you are putting 95. outflow 95. At the end of year 1, you will get on $100 is the nominal value, you will get $6 interest. End of year 2, you will get $6 interest. End of year 3, you will get $6 of interest. And at the end of year 3, you will get your capital repayment 105. I want you to ask a question. Now, let's assume that, we know there's what we call time value of money, the discounting rate. The money value drops with the discounting rate or the interest rate. So today, your present value of money what you invested was 95. Okay? Present value of money what you invested on 95. You are going to get 666 and 105. Now, once you discount, what happens to this money value, Bojo? Now, look at the without discounting, what is your total value? 18,123. Correct? When you discount it at 10% or 11% or 12%, this 123, will it go up or will it come down?
Come down.
Come down. Right? So let's assume that you discount it at 12% or something like that. I'm just taking some arbitrary figures. At 12% when you discount it, the present value of all the money what you are going to get is 101. When you discount it at 12%, the present value of all what you are going to get is 101. So in fact, the NPV is plus 6. Good or bad?
Good.
Good, right? You have a good. So at 12%, if your cost of capital is 12%, it's a good investment, isn't it? Now, what happens, say, I'm just taking some rough figures, I'm not taking accurate figures. At 12%, it is 101. If I discount it at 15%, what will be the figure? Will it be more than 101 or less than 101?
Less.
Less. Good. Less. Because the higher the discounting rate, the value comes down. So what I want to see is, okay, when I discount it at 15%, this is coming down to 94. Good or bad?
Bad.
Bad, isn't it? So you can see, now you can see the nice picture. So at 12, you're all right. At 15, you're not all right. So somewhere in between 12 and 15 will be 95 and 95, which is the cutoff rate, isn't it?
Yes.
So between 12 and 15, we will have, this is what we call, you remember in your P1 time, you would have learned something called internal rate of return. What is internal rate of return? When NPV becomes 0. Correct? Internal rate of return is NPV becoming 0. So between 12 and 15, there is a particular rate, maybe let's assume it is 14%, that will be, so your cutoff rate, you will be expecting the minimum return that you will expect is 14%, right? At 12 you are happy, but 15 you are not unhappy. So the minimum rate that you will expect is 14%. That's the cutoff point. Now this is what we call, in a situation like this where we have a kind of an irredeemable situation, redeemable situation, the cost of debt is in this case 14%. So we have a formula to work it through. So we will work through this formula with some numbers to get this idea right into our head on the redeemable debt. So that one we will do it. You are okay on Thursday?
Yes.
Shall we make it Thursday? Same time?
Yes.
Yeah.
Yes.
So we will continue from here. I think I can finish up the cost of capital on Thursday. We will start with this yield to maturity with some numbers and we will work through.
Okay.
Okay, so I'll see you on Thursday at the same time, Bojo.
Okay, see you.
Okay, have a great day. Take care.
You too. Bye.
Bye. Bye.